So basically, whenever you are trying to analyze the financial statements of a company or you are trying to analyze a stock, always give more weightage towards the cash flow statement as compared to the profitability of the company or the profit and loss statement. Because the profit and loss statement at times can be manipulative, but the cash flow statement will not. Why? Just try to understand what the profit and loss statement tells us. A profit and loss statement is also called as the income statement. So it's a summary of the revenues and the expenses of a corporate. If the revenues are more than expenses, the firm makes a profit. But if the expenses are more than revenues, the firm incurs a loss. Correct? So this logic we know. But if we talk about the sales component in a profit and loss statement, that sales component on the credit side, which is bringing us cash, it includes both the cash sales as well as the credit sales. I'm repeating my point. In the profit and loss statement, in the sales component on the right hand side, on the credit side, it shows both the cash sales as well as the credit sales. Cash sales is fine. Assumingly, we have sold something to somebody, like to some other businesses or to customers, the customer has paid us back. But the problem is the credit sales. It's not always a problem, but it's a problem when the person may not return us back the money, right? But that component of the credit sale is still being a part of the profit and loss statement because the profit and loss statement is built upon the accrual system of accounting. It's not based on cash system of accounting. Whether cash is received now or after some time, some quarters or some years, it will still record it because it records all the transactions when they are incurred or occurs, but not when the actual cash is received. Now, the credit sales, all the businesses they try to run upon the credit sales. If I have sold something to some other businesses, and if a person has not returned me back the money, till that particular tenure or point of time, it's a credit sale for me. Now, that quantum can be very high, it can be mediocre, or it can be low as well. But the problem is if I do not get the money, if those credit sales do not get converted to cash, and that is the problem, right? Now, the people can ask me that the companies tend to set aside some provisions also for bad debts. Agreed. But the provisions are not for the whole value of the bad debt. So, for example, if I've made a credit sale worth rupees 100 rupees, I'll be setting out provisions for 10% of that, 20% of that, or 30% of that. I cannot set aside provisions 100% of that. Because if I'm setting aside provisions 100% of that, it clearly states that I believe the person will not pay me back the money. And if I believe the person will not pay me back the money, then why in the first case I will sell it off to him, right? So all that component of the credit sale might not get converted to cash. Now here I'm not saying it happens for all the companies, but for the rarest to rarest of the companies or in the bad scenarios, in times of depression, in times of recessions or some black swan events, when the credit conditions might be tight, right? The market environment might not be doing so well. There might be some geopolitical tension, some customer supply relationships kind of getting hampered because of that, right? So that amount of the credit sale might turn out to be a bad debt in future. And some provisions might be set aside, but not of the whole value of that. Correct. But still, like coming back to the square one, still that component of the credit sale is included in the component of the P&L. Now, I'm not saying it's bad, but it's the way the P&L statement is constructed. And that is why I'm saying it's get constructed upon the accrual system of accounting. Whether cash is received or not, it doesn't matter. When the transaction occurs, buying and selling is done, cash is being paid after 6 months, 1 year, 2 years, still that amount will be recorded, right? And that amount can inflate your profit up to that extent, right? It might happen that the profit of the company might be over boosted or might be sheerly high because of that component for credit. Now, here we need to see that if the company had made sales, assuming that you have 500 crores of sales the company made, correct? 400 crores were cash sales and 100 crores were the credit sales. So in this case, we can say the maximum portion or the maximum quantum of the sales out of the 500 crores, that is 400 crores is cash sales. Safer side, safer business. And thus 100 crore is the credit sale. But if you see a business where 400 crores is the credit sales and thus 100 crores is the cash sales, it might be a problem there. Because the larger quantum is the credit sale and the smaller quantum is the cash sale, right? Now, if some bad conditions happen, a majority of that amount might turn to be as a bad debt. So that is something we need to analyze. And how do we get the bifurcation of the credit sales and cash sales? It's notes to accounts. Like whenever you go to the annual report, and that is mentioned in towards in the modules also, where I've tried to discuss everything from A to Z about the annual report, P&L, cash flow, balance sheets, the statement of equities, notes to accounts, all that kind of bifurcation for majority of the companies you tend to find in there. Always see that whether the maximum proportion of the sales is coming from the cash sales or the credit sale. If the maximum proportion is coming out of the credit sale, just wait and try to have some more kind of analysis and discussions upon the company. If not, then really good, right? But you might also find some good fundamentally strong companies having the major portion as the credit sale. For that, you need to see the history. You need to see the debtors turnover ratio, the debtors turnover days, and all these things you need to see and try to analyze the past. And that is why we prepare the financial model of companies, and that we'll do later, right? And that is also present in the modules, also deep dive. And we also have to begin with a core financial modeling exercise, maybe from the subsequent session. Okay. So that is something we need to analyze. But a cash flow statement will always record that cash sales component and never the credit sale component. So a cash flow statement is a more realistic statement of the financial performance of the company. It might happen the company might have a higher amount of profit, a PAT or a profit after tax, but a lower amount of cash flows. And that clearly indicates that some items of the credit might be there in the P&L statement, but the cash flow is actually recording how much profits have been converted to cash. Because profits don't mean cash. Not all the profits are convertible to cash. If those profits are convertible to cash, or if some actual cash has been received or paid via the operating activities of the business or the investment activities of the business or the financing activities of the business, those are just highlighted in the cash flow statement, just the actual cash. So always pay more weightage towards the cash flow statement and less towards the profit and loss statement. Any questions to this point of time? Anybody? That why we need to pay more weightage towards the cash flow statement and less towards the profit and loss statement. Because it's a very popular interview question as well. That whether you will prefer a cash flow statement or the profit and loss statement. And then most of the people tend to answer the profit and loss statement because it's much easier to make. You have all the account of revenues, expenses, and you get the profit and you can bifurcate everything. But the cash flow statement is difficult to make because you have different kinds of methods to prepare the cash flow statement, direct, indirect, and like some activities might not be there or might not be like easily understood, or you might not be able to bifurcate between operational activities, investment activities, financing activities, right? And that is a silly reason which people tend to give. And the reason that you have to give always is a cash flow statement is based upon the cash flow basis of accounting, whereas a profit and loss statement is based upon the accrual system of accounting. A profit and loss statement also records the credit component of items on account of which the profit might be inflated or overboosted, because it is not 100% guaranteed that the credit component might be converted to cash. Whereas if we talk about the cash flow statement, it always records the actual cash which has been received, the actual inflows and cash outflows, no credits, no accruals. That's it. Point to point answer. Synchronized, simplified, done and dusted. Any questions, anybody?
Can you please explain me this operational, investment, and finance modules in cash flow?
Yeah, that I'll come to that. I'll come to that.
And the second query is that suppose if some X company is there, they must have sold the subsidiary. Will it come under the cash flow or it will go under the P&L type?
See, I'll come back to your second question first. So if a company has sold in some subsidiaries, right? So that subsidiary is a part of its investment, right? It has invested into that subsidiary. It was a part of that business, right? So that will come as a cash flow statement because the company has sold off that subsidiary and got that money. Okay, got it, Chaitanya?
Yeah, got it. But in cash flow, it consists both core and non-core business.
A cash flow statement will be basically considering the more core activities, right? And a minor, majorly would be your like core and the operational activities. But some items, if the company are selling it off, so like for example, if you are like selling off your subsidiary, right? and there might be some sale of discontinued businesses or sale of scrap. So all these do not occur on an annual basis or like everyday basis. Like these are like one-off activities, correct? So these one-off activities we tend to include as well in the cash flow statement, but you might not find them always because these are like one in the odd activities. Okay. सो
Okay,
बेसिकली
okay, fine.
मोटा मोटा ये फंडा है कि कंपनी को जहां से भी कैश मिल रहा है या जहां पे भी कंपनी कैश दे रही है, सो दोस थिंग्स हैव टू बी रिकॉर्डेड एनी हाउ. ओके. I'll be coming to the operation, investing and financing activities. I'll just share my screen as well for that. Okay, so this is the Nestle annual report and this is the cash flow statement. So see, for example, if someone asks you in the corporate interview, right, can you explain me the difference between the cash flow from the operating activities, cash flow from investing activities, and cash flow from financing activities, and how you guys need to answer. So basically, the major agenda, I would say, or the major, I would say, the premise is the cash flow statement is being divided into cash flow from three activities. Okay. Number one, cash flow from the operating activities. Number two, cash flow from the investing activities. And number three, cash flow from the financing activities. So basically, on account of these three, cash flow statement is being made. All the positive numbers that you see that are without the brackets, all those are cash inflows. It means the company has received cash in those transactions. And all the brackets, well, the values that you see, it's cash outflows in which the company has paid out the money. And this is the net value, that net out of the cash flow from the operating activities has company got cash or paid out cash, or it has been a cash inflow or a cash outflow. All these items, each and every item of the cash flow statement, its calculation, be it for P&L, be it for balance sheet, everything has been a part of your modules too. So not to worry for that. Okay. Just give me a second. I'll just reshare my screen once again. So all these things have been a part of our modules too, where everything has been discussed. Those who have already watched in the modules, they know about it already. Each and every line item, it's calculation, right? So I'm not going towards the calculation per se. It's a more generalized session, right? Because multiple people are busy towards their college sessions today. So I just want to touch base some different topic with them when all the students are in here. Okay. So यहाँ पे you have the cash flow from the operating activities. So for everyone and Chaitanya also, the thing is, the cash flow from the operating activities basically tells us what has been the cash inflow and the cash outflow from all the operating activities of the business. And what are the operating activities of the business? These are those activities for which the business has been established, or all the activities which are directly or indirectly linked towards the operating activities of the business. So, for example, if I am running a fast moving consumer goods industry, then my activity is to purchase the raw material, to manufacture the goods, make the final product, do packaging and like all that stuff, and sell the final product in the market. So those are my direct activities. But there can be some indirect activities being related towards, because there might be some plant and machinery like which is being run and some depreciation or some amortization being charged upon my technology. So that is something which is indirectly linked to my operating activities. So everything which is the actual operating activity or directly or indirectly linked towards my operating activity. So that is something the cash flow from the operations. Second one we have is the cash flow from the investing activities. I'll take up your questions as well. Just hold on. So cash flow from investment activity. So as the name suggests, all those kinds of investment that we have made, buying and selling of plant, machinery, heavy goods to run our operations. These are cash flow from investment activities. So as my friend Chaitanya also said, ki selling of subsidiaries. So it was an investment that the company had made in that subsidiary, and now the company has sold off that subsidiary. So whatever money the company will get by selling off that subsidiary, it will be a cash inflow for that. So that shall be regarded into cash flow from investing activities. And the third one, we have something as a cash flow from your financing activities. So all those financial transactions, loan taken, loan given, interest paid, interest taken, which are apart from the operating activities of the business, dividend paid, dividend received, equity raised, all those kinds of financing activities. And but here, it's important for all of those who are still wondering how to arrive at these items or why these items are a part of a specific head. Just go back to the modules. In my very first three sessions, I've talked about annual statement, annual report in detail. All the financial reports, each and every line item, its interpretation, discussion, why not. All these things are present in here. So not to worry for that, right? And one thing also we need to understand that whenever we are trying to prepare a cash flow statement, the operating activity might differ from a company to company. For example, if I talk about loan taken or loan given, if Nestle is taking loan or Nestle is making some payments or loans or like some interest payment or loans. So giving loans or taking loans is not the operating activity for Nestle. Nestle is into the fast moving consumer goods industry. Buying the products, the consumer discretionary, the consumer non-discretionary products, buying and selling staples, soap, shampoo. I mean to say not for Nestle. For Nestle, like it's more of noodles, your like Maggie and all, like some confectionery, your chocolates and cereals and all that stuff. But basically, like if you talk about the fast-moving consumer goods industry, it's all about soaps, shampoos, ration, right? Your day-to-day groceries, correct? So basically, taking loans and giving loan is not the bread and butter of Nestle. But if this statement had been made for HDFC Bank or ICICI Bank, then taking loan or giving out loan, paying interest or taking interest would have been in the operating activities of that company and not in the financing activities. Because operating activities, as I clearly told you, these are the रोजमर्रे के काम जो company के हैं, day-to-day activities of the business, the core activities of the business, the core operations of the business. The core operations of Nestle is not to take loans and give loans or to pay interest, and that is why it's in the financing activities. But the core operations of banks and the NBFCs is to take loan and give out loans. Hence, they won't come in the financing activities then. It will just come in the operating activities. But if those banks or the NBFCs have taken loan or given loans apart from their working operations or like apart from their working capital. So for example, if they might have taken loans not to make profits, right? They might have taken loans to maybe like invest in markets, right? So that might be an example of financing activities, right? But as a student of finance, you need not wonder that what part will come under the financing activities, what part will come under the investing activities, because you already will be having the annual report with you. You need not create the annual report as a financial analyst, as an equity research guy. You get the report handy. CAs, CAs, and different people of those companies have made the reports. They are published in market. You need not worry कि कौन सा item कहाँ पे आएगा. Correct? But the logic at least you can just relate. ऐसे क्यों हो रहा होगा? Any questions, anybody? You guys can just raise your hands. I'll be happy to unmute you. Any questions, anybody? Does anyone has any question? Is it clear till this point? Yes or no? Yes, yes, yes. Is your doubt clear, Chaitanya? I would say in an holistic way. I would just ask you that what exactly is the bifurcation between these statements? What is the difference between uh, venture capitalist of investment bank? Matlab, are you asking that what's the difference between venture capital and IB? Divesh, like what's the question exactly? What's the difference between venture capital of okay? See, venture capitalist is a part of investment banking. Like we talk about VCs and private equity, it's not different from investment banking. It's a part of a profile in IB. Because whenever you go for like investment banking profiles, you have various profiles: equity research, financial modeling profile, you have investment specialist profile, you have the venture capitalist, private equity profile, right? So basically, if you're talking about a venture capitalist profiles, these are basically for your new age startups and VCs, right? Because these VC firms, they tend to raise money from the market and they invest into the startups. Like if you talk about Zomato or a Swiggy or a Policy Bazaar, Nika, so major chunk is being held by different VCs all over India or like outside India. So all those major companies, or especially the VC companies, they tend to raise money from outside sources and they tend to invest into such companies. Now, when to invest, how to invest, how much to invest, at what multiple to invest, at what multiple to sell it off, what should be the lock-in period, what should be the clauses, right? So a major profile, if you're going towards a venture capitalist profile, you need to know about the startup world. You need to know about the venture capitalist valuation. So for example, if I'm a VC and I want to invest into Swiggy, I would just not be putting my money into Swiggy blindly. I'll be seeing the valuation of Swiggy. I'll be seeing its revenues. I'll be seeing that when the company can break even, or like when the company can attain to be profitable in future, right? I'll be seeing the enterprise value of that company, value for debt, equity, everything. I'll be like looking into place. I'll be talking to the management of the company. I'll be seeing their pitches. And if I'm interested, I'll be pouring money into the company. And when I'm buying that company, the company shall be giving me some stake. I might be purchasing a 1% stake, 2% stake, 5% stake, like depending upon my risk appetite and how much worth of shares I want and how much worth of shares the promoters of the company can give to me. So the multiple clauses, multiple methods, multiple approaches, how will I be paid? I might be paid in terms of cash. I might be paid in terms of stocks. I might be paid in terms of simply as a shareholder. I might be having some different clauses, right? I might have given loan as the VC, and that happens in the private debt market. It's almost the vice versa of the private equity. I might have given loan to this company, and the company might do good, and I have the right to convert my debt to equity in future, right? So the extent of the interest payment or the principal payment, I can convert my debt to equity. So various clauses for the venture capitalist world, angel investor world, private equity world. So they basically work with startups or the growth oriented companies or with those companies which are on a stage of decline. So they not only work towards startup companies, they also work for those companies which cannot like flourish in the market, which might go out of the market, the companies which might collapse. So how to revive such companies? They also fund the processes of mergers, acquisitions, LBOs. It's a very wide topic in the VC and the private equity world. I can just give you a summary out of it right now because that's not a topic for discussion. But like just to tell you in general, कि जब भी तुम किसी कंपनी को खरीदने जाओगे, you'll see at what valuation to buy, right? At what price to earning multiple to buy, at what price to book value multiple to buy. If it's a loss-making company, what price to sales multiple to buy, what EV to revenue multiple to buy, what invested capital to a book value multiple. Am I on mute? I'm already on mute. I was unmuted, right? I wasn't on mute. Like, were you guys able to hear me? Apart from Chaitanya? Devesh? Like, was there... Hello? Yes, we can hear you. Okay, so you heard about the VC and the private equity discussion, Devesh, right? You heard about it, correct? Yes, sir. So, Chaitanya, maybe you can just log in. So you want to speak something, na? Then say it, na? I allow you to unmute. Chaitanya, tell me.
See, regarding this cash flow operations, we have three modules: operating, investment, and finance. All
Mhm.
three consists of weightage or depends upon means level to level.
Can you please repeat your question? Your voice was a bit like blurry in
We
between.
have a cash flow. Cash flow. We have three modules. One is the operating, investment, and financial.
Mhm.
All three consist of same equal weightage, or it may varies from different to different.
Equal weightage always.
Acha, equal weightage means
Correct.
will there be any fluctuate if there is any fluctuations between these two year on year? How can we read in such cases?
So that we need to see ideally. We need to compare the previous year cash flow statement with this year cash flow statement. And then we need to compare each and every line item. That which item has increased, which item has decreased, and what is contributing to the actual inflow or the outflow of cash. Okay, so that comparison you will learn once you go through the modules. At least start with the modules and you'll have an idea about that in a very deep dive manner. Okay, so all that kind of comparisons. So not to worry for that. Anyone else? Any questions? Okay, back. So here, if I just go in here, and one more thing that you always have to see is that whenever you are trying to analyze a cash flow statement, always see if the cash flow from the operating activities is greater than or more than the purchases of the property, plant, equipment. What do I mean by that? If you see in here, the cash flow from the operating activities is 41,000 crores. Whereas the purchase of the property, plant, and equipment, including the capital work in progress, is 18,000 crores. Above, the net cash inflow is from the operating activities because सब कुछ add subtract करके we got the number as a positive 41K. Whereas whenever we are purchasing some property, plant, equipment, the cash is going out of our pocket, right? The cash is going out of our pockets, and that is why it's shown as a negative number. So always see whether these purchases are greater than or more than this amount. Because if the purchases amount is less than the cash flow from the operation, it clearly states that the firm has enough cash to fund its operations, to fund its investment activities. That is, enough cash has been generated from the operating activities of the business, and that can be used to purchase plant, machinery, equipment, or the fixed assets of the business. That's a very good indicator. But if the net cash flow from the operating activity is less and the purchase of the property, plant, equipment number is more, then the company might have to raise more debt to fund its operations. And that shall be highlighted in the cash flow from the financing activities. And then your net debt increase or the interest payment in the cash flow from the financing activities will increase over and above year after year. But if the net cash is more from the operating activities as compared to these purchases, this line item, it means the company has enough cash and the company can reinvest that cash into business to purchase property, plant, equipment. So that is one thing we need to understand. And that is why each of these heads are paid equal weightage, because all these line items are interrelated. If the cash flow, and even an analyst who looks towards these statements, whenever someone is into an equity research profile or simply a financial statement analysis profile, he tends to see that the cash flow from the operation is very good and it can fund all those investment activities, right? All the investment activities can be funded out of the operating activities of the business. So the company के पास cash तो काफी है, right? कि companies अपनी plant machinery भी इस 41,000 से खरीद सकते हैं. But if the vice versa is there, I'll see my balance sheet. Hypothetically assuming I'm seeing my balance sheet, I'm seeing that the long-term liabilities are rising. Why? I'll go to the cash flow statement. I'll see, okay, the cash flow from the operating activities is less than the cash flow from the investing activities. So maybe the company is raising more debt, like more long-term liabilities to fund its investment activities. So a kind of a relation or a correlation I can try to establish between all the statements. Got my point? A yes or a no? Any questions, just let me know. I'll be happy to unmute you. I've just muted you all just to maintain some good atmosphere, like so that गलती से भी किसी का mic unmute ना हो and that doesn't interrupt the teachings. Everyone else with me? You got the logic that why you look towards the operating activities and investment activities and financing activities all together and try to establish a relationship between the three? Got my point? A yes or a no in the chat box. Chaitanya, Pooja, Prateek, Narendran. Good, good, good. Any questions? Just let me know. You can either type them in the chat box or you can just ask me to unmute. Or like you guys can just raise a request to unmute. I'll just unmute you almost immediately. Okay. So that is one thing. The way you have to try to link dots, as we talked about the accrual system of accounting and the profit and loss. We talked about the cash-based accounting and the cash flow statement, and how to link these different statements all together. Okay. So that is one thing. Someone who is present in this session asked me one thing. I would say not someone, but most people, they were undergoing some projects in their colleges, right? They were undergoing some projects in their colleges, and they had a very important question, a very important doubt. Just let me know if the Word document is visible to all. Is the Word document visible to all? Okay. Yes, yes. Okay. Can anyone tell me the difference between the price to earning ratio and the price earning growth ratio, PEG ratio? I'm just touching this base out of nowhere because that is a doubt from many people like who are like undergoing their college projects and my projects too. And they want to calculate these ratios. Anyone wants to add on or say something about the price to earning ratio and the PEG ratio, price earning growth ratio and the price to earning ratio? Anyone wants to take a shot? Nobody? Have you guys heard about these ratios? Price to earning or the price earning growth ratio? We'll talk much more about these ratios also, not to worry. Like once we talk about relative valuations and the financial modeling, but just out of nowhere. Anybody? No one knows about these? Okay. So see, if we talk about the price to earning ratio and the PEG ratio, first let's try to understand them very from the formula perspective. So if you're talking about the price to earning ratio, it's taking into account the current market price of the share in the numerator and the EPS in the denominator. That's your price to earning ratio. So whatever is the current market price of the share in the market, irrespective of the time period, to take that divided by the earnings per share. How do we calculate the earnings per share? The earnings per share is calculated by your profit after tax divided by the outstanding shares. I'll go slow in here. So see, the formula for the price to earning ratio, again, it's a valuation metric. It talks about the current market price of the share in the numerator and it divided by the earnings per share. The question that might come into place is how do we calculate earnings per share? The earnings per share is calculated as the profit after tax in the numerator divided by the outstanding share the company has in the denominator. Again, the profit after tax can be simply found from the profit and loss statement of the company, annual report, moneycontrol.com, whatsoever. And same with the outstanding shares. It's present in the balance sheet, notes to accounts. बहुत simple number है. Correct? Let's try to decode the denominator first, EPS. So EPS is basically telling you earnings per share. How much earnings the firm is able to provide on a per share basis to its shareholders. How much earnings the company is able to provide on a per share basis to its shareholders. Higher the EPS, it is good for the company because it means the company is able to provide more earnings or the company is able to perform in a much better way. Higher the EPS, it's good for the company because that is showing the profitability of the company is also rising. So EPS is a proxy for the earnings growth of the company. Mention this line, remember this line always, that EPS is a proxy for the earnings growth of a company. Whenever you watch online platforms like CNBC, C Business, NDTV Profit, ET Money, Bloomberg TV, they say earnings growth of a business. The earnings growth of a business are very strong. They talk about the EPS is very strong. EPS is rising year by year. So whenever someone is saying the earnings growth of the business are good, it means the EPS of the business is good, or the growth rate in EPS is good. Clear? EPS is earnings per share, how much profit the company is able to make on a per share basis, or simply how much growth or how much profit the company is able to make. Simply EPS बढ़ रहा है तो कंपनी का प्रॉफिट भी बढ़ रहा है. Now, this EPS is taken in the denominator and the current market price is taken in the numerator. And what do I mean by the current market price? As of today, wala, not historical. So for example, if as of today, so today is 16th of November 2024, I want to calculate the price to earning ratio of Nestle. So I'll be taking the recent price of Nestle as of today. So आज तो market बंद है and कल भी market बंद थी. So I'll be having the recent price as of Thursday. So I'll be taking the most recent price of Nestle in the numerator and dividing it by the earnings per share of Nestle. Now, the problem with the earnings per share is EPS you don't get on daily basis, or EPS ka number is not available on daily basis. EPS is always available on annual basis or quarterly basis. So preferably, we always take an annual EPS and not a quarterly EPS because we want to analyze the company annually and not for a short-term period, just like quarterly, because एक quarter से company का कुछ पता नहीं चलता. Now, this EPS will be available as of the latest available financial statements. So in India, the calendar year starts from 1st of April and ends on 31st of March. So I'll be having the latest profit after tax on the outstanding share as of 31st of March 2024 only, right? Yes or no? I'll be having the latest profit after tax and the outstanding share of Nestle India as of 31st of March 2024 only, right? I won't be having it as of like 14th of November or 13th of November, correct? But price I'll be having on daily basis because price tend to fluctuate daily. There might be some positive sentiment in the market. On account of that, the price might rise. There might be some negative sentiment in the market. The price might fall. कोई fake news आएगी, price बढ़ जाएगा. कोई बेकार news आएगी, price गिर जाएगा. There might be some other scenarios. Some news on raw materials, some news upon consumer demand, urban demand, rural demand, and the price will fluctuate, right? Do you agree with me, everyone, that the price will fluctuate on daily basis? Every day, a company will have a new share price, but the EPS will just be calculated based upon the latest financial statement and not daily. Even if the price is changing by some few decimals, 0.01%, but the fluctuation will be there every day. But the fluctuation EPS will not be there every day. Agreed? Yes or no? Great. So basically we can say, see what is happening. Price is something which we are getting on daily basis, but EPS is something which we got as of the latest financial statement, 31st of March 2024. तो उसके बाद we had the quarterly results, but quarters हमको मतलब नहीं, we just want the annual numbers because we get more better numbers in an annual statement because quarterly numbers can be manipulative also. एक quarter में company can do some window dressing and manipulate the numbers, but annual में they tend to get more streamlined. So here we can say that price is a leading indicator and EPS is a lagging indicator. Correct? Because price is something which is changing every day on the basis of sentiments, on the basis of the future projections. But EPS is something which we have historical EPS with us as of 31st of March 2024. We do not have the EPS as of 16th of November 2024 or per se like 14th of November, the last Thursday working. But price we have on daily basis. Right? Just give me a. So that is something that will keep on happening on daily basis in terms of price, right? But in terms of EPS, we just have one past historical data, correct? So that is one thing. Ab, see what basically happens is price being a leading indicator and EPS being a lagging indicator. And when we talk about this price to earning ratio, we say that when the ratio is high, right? it means the stock is overvalued, right? But if the ratio is less, it means the stock is undervalued. If we talk about the price to earning ratio. So whenever we are trying to calculate the price to earning ratio, we always see as a part of industry average. So for example, if I'm talking about the IT industry, if I'm talking about the IT industry, so basically in the IT industry, if the average price to earning multiple of the IT industry is 24, assumingly, if the average price to earning multiple of the IT industry is 24, okay? And if I'm researching upon a stock which has a price to earning multiple of 14, it means that the price to earning multiple of my stock is less than the average multiple of that particular industry or sector. And this we always see sector wise. So I can say that my stock is undervalued and I can purchase that. But if my multiple is 28 or 30 or 40, then I can say that my stock is overvalued as compared to the industry and I can sell off that stock, assumingly. If my price to earning multiple is lesser than the average multiple of that sector, that average multiple can be as of 5 years or 10 years per se, right? Then my stock is undervalued, I can purchase that stock. But if my average multiple is more than 24, right? Then what is the thing? Then I can sell off that stock in the market, ideally in an ideal scenario. And that is where the price to earning commits a mistake. Ideally, what the price to earning is telling you, if a price of the share is too high, if the numerator is too high, but the denominator is less, where earnings are less, it means the stock is overvalued, but the earnings are not supporting the price. Earnings से बहुत ही कम है, but price बहुत high है, stock का बहुत high price पर वो market में बिक रहा है. It means the stock is sheerly overvalued. The earnings are not supporting the price. But if the vice versa is there, the price is low, but the EPS is very high. In that case, the ratio will come down and we'll say the earnings are very strong, but the price is very less. The stock should trade at a higher value because the earnings are very good. In that case, we can say the stock is undervalued. Correct? So that is happening in case of a price to earning ratio. But the thing is, the price to earning ratio is taking one lagging indicator and one leading indicator. Just on the basis of a lagging indicator, how can we predict that a price to earning ratio on the basis of that में company हम खरीदेंगे या बेचेंगे? In an ideal scenario, in the real life world, it's not always good to purchase an undervalued stock. Just make a note of this point. I'm repeating my point once again. It's not always essential, compulsory, or mandatory or good to purchase an undervalued stock. Also, it is not compulsory, mandatory to always sell an overvalued stock. A stock might be undervalued. A stock might be having a lower multiple in terms of price to earning. Even if the fundamentals are very poor, the profits are very poor, the cash flows are very poor, debt is very high, the management बहुत खराब है, company बर्बाद है. Still also in that case, the price to earning might be very less. A stock is always categorized as undervalued in terms of price to earning if its earnings are very strong, management is strong, cash flows are basically based upon earnings only because वो earning multiple पे हो रहा है calculated. So basically earnings are very strong and then it should be undervalued. But if it is not, if it is has bad earnings, bad profits, company kharab hai, even in that case also it might be trading at a very low price to earning multiple. And the vice versa also. A stock might be trading at a very high price to earning ratio. It is not always compulsory to sell off that stock always. It might happen. What might happen? It might happen that the company might be doing really good, outperforming the market leader. EPS every year is rising. Prices also rising, but earnings are also rising. The growth rate in earnings is supporting the price. EPS is rising every year and the price is also rising. So why to sell off that stock? You can even add more or have a hold position. In the past 1 year or 2 year, we saw the market becoming overvalued. Stocks becoming sheerly overvalued on the price to earning basis. People told to sell off, sell off. Now in the recent past 1 month, the market has started to correct by more than 10-12%. But before October, or maybe I would say October first week, the market was still rising. The stocks were surely overvalued. They crossed the past averages, 5-year average, 10-year average, but still the stocks were rising. Why? Because the earnings were supporting the stock. If they are good earnings, the price is also rising, then what is bad in that? If the earnings are not good, but still the price is rising, then it is bad. And that happened with the recent quarter results. Mostly for all the companies, the earnings have started to fall. The future projections of the earnings are also in lower single digit. 2 से 3% के projections हैं. But the price was still rising. And that is also one of the reasons, apart from the FII selling, the stock started to come down. Because now the earnings projections were not so good. In the previous quarter, the earning projections were good. 13%, 15%, 20%, high two-digit number, right, for the companies. And the price was also, I think, very good. But in the recent quarter, the earnings projections have come down 2%, 3%, and still the price is rising. And once the numbers came out, and once the actual numbers came out, and the projections followed afterwards, the stock started to sell off. The market, people started to understand the price is rising, but the earnings aren't supporting that stock. Because of the previous quarter, the price was rising, but the earnings were also supporting the stock. But in the previous quarter, yeah, people realized in the previous quarter, if the price was rising, the earnings were also supporting the stock. But once we had the previous quarter ka result, the earnings are not supporting the stock, and hence the prices came down. Same with the small cap and the mid cap. The small cap stocks and the mid cap stocks are sheerly overvalued based upon the price to earning multiple. Mid cap के multiples भी बहुत high चल रहे हैं, 16x से 24x, small x बहुत sheerly high चल रहे हैं, like 30-40% premium पे. But if you look towards other ratios, small cap and mid cap were relatively stable. And what are the other ratios? And that is why I'm stressing upon the second ratio, which is your PEG ratio. PEG ratio is something which is a very important ratio. It's much more important than the price to earning ratio. It will give you a much better and a clearer picture as compared to a price to earning ratio. Whatever price to earning ratio cannot give you, price earning growth ratio will give it. PEG ratio. PEG ratio का formula क्या होता है? You have the price to earning in the numerator. So ये पूरा ratio you have in the numerator and divided by the growth rate in EPS. Here you just had EPS, just one number, historical EPS. Here you have the growth rate in EPS. And what do I mean by the growth rate in EPS? If the EPS of last year was 5 and this year it became 10, what's the growth rate? It's 10 minus 5 by 5. Correct? 100% से बढ़ गया. So here we take the growth rate in EPS or the average growth rate in EPS of past 5 years, because ideally we prepare a financial model for the next 5 years. So you can take a growth rate of EPS for the past 5 years. And why this ratio is a better version than the price to earning ratio? Because in price to earning, the EPS is just historical. It's a stagnant number. It is not telling you that whether EPS is increasing or decreasing. You just take a previous year ka EPS. But in the price earning growth ratio, you are taking the growth rate in EPS. You actually get to know if the EPS is increasing or decreasing. And if that is increasing or decreasing, that affects your price to earning multiple. So coming back to small cap and mid cap, small caps and mid caps were sheerly overvalued in terms of price to earning ratio. Sheerly overvalued. Mid cap index, we generally like tend to see the Nifty 150 mid cap in India. Nifty 150 mid cap index. Its average 10-year multiple is around 16x. It became like 24x or something. Same for small cap. The average multiple is around like 24x or like 25x. It became 34x. 30 to 40% premium पे trade कर रहे थे. And still people were purchasing mid cap and small cap. Still the market was not coming. Though currently it has come down, but before October first week, people were still buying the mid cap and small cap irrespective of the higher valuations. People from 2022 end are getting sell mid cap, sell small cap. But still for 1.5 years, still people purchased. तब भी उनका price to earning बहुत बढ़ गया है. At that time, they were like 10% premium, 20% premium. Now they're 40% premium or like 50% premium. But still people purchase it. Because when they calculated the PEG ratio for that company, that was closer to 1. Ideally, when the ratio is closer to 1 in terms of PEG, It's fairly valued or undervalued. 0.8, 0.7, 0.9 आगे undervalued. 1 है fairly valued. 1.1, 1.2 भी है still fine. For both the mid cap and the small cap. The PEG ratio was around 1 to 1.1 की range में. Why? Because this earning growth was not getting encapsulated in the EPS, because EPS is just giving you a past year ka number. But that earning growth ka trajectory was getting encapsulated in the growth rate of EPS year by year, quarter by quarter, how much EPS is rising. And that's more important in terms of mid cap and small cap. We actually need to realize how much is the growth rate in their profits in their EPS, and that will translate it to the price. And that is why in terms of the PEG ratio, the mid cap and the small cap was still closer to fair valuation. And that is why fund managers and portfolio managers still purchase the mid cap and the small cap based upon PEG ratio and not the price to earning ratio. But now, as of November, even the PEG ratio has started to increase for the mid cap and small cap. Why? Because the earnings number are not so strong, right? And also the mid cap and the small caps have corrected. And that is why investors or the portfolio managers, the fund managers have started to change their tactical bets. Maybe I would say the strategical bets from mid cap and small cap to large cap now. Any questions, anybody? Any questions, anybody? But did you guys learn something new and unique? Was it something new and unique that you learned about price to earning and PEG ratio? Yes or no? So always pay more weightage towards PEG ratio and not towards price ratio. I hope, like Prateek, you also learned something new, right? You can just mention in the chat box about the PEG ratio as well as the price to earning ratio. And I hope you are enjoying the session too. We though have limited people in the next session, the guy is gonna meet a lot of people around you. It is just multiple colleges have the Saturday sessions being scheduled. I don't know why on the same day at 2 p.m. But anyways, and that's why I just touch base some important topics in today, for which like many people ask me questions about their college projects and stuff. Okay, that is one thing.